So this one is for Crypto Queen. This one and the last one for Ross, they're both part of the Discord, and they specifically requested these videos. Crypto Queen wants me to go in depth about escape velocity. And I use the analogy of escape velocity as if you're exiting a black hole, but the black hole would be your everyday expenses and what you need to, escape the black hole using escape velocity. It's a mathematical formula. We'll go over it real quick, but we're not going to spend too much time on it. The idea really is to reach an inflection point to when you're generating either enough income through dividends. We do a lot of option selling. Obviously, some of that has to go back in to buy back in, and it has to be able to provide consistent income. So that's kind of what we're going to go over. Real quick, here's our black hole. Escape velocity is 2gm divided by r, 2x, the universal gravitational constant, multiplied by the mass of the object divided by the radius. That's escape velocity. All right, so we need to solve this as if this is your monthly liabilities, okay? Because here we're doing finance. I have no intention of running into a black hole, but some of us feel like we're in a black hole sometimes. And so Crypto Queen wanted this, and it's something we constantly go over. When you start down this investing journey, you're gonna start seeing my dividend rate, and you're gonna see cash flow numbers, premiums, profits, etc., etc. But you don't really. No one actually ever goes into how much do you need to live on, and how much can you safely withdraw without eroding your capital. So imagine you have 500,000 in your account. It's not a great deal of money. It's pretty common for the members of my group. These are the kind of numbers we're dealing with, and you're consistently making, say, 100,000 in profits monthly, and this is because we do options. Okay, we buy and sell options. We have some dividends too, but how do you know how much to safely withdraw? That becomes the question. Okay, so you need to know what your monthly expenses are. And I would say you want to multiply those by a factor of 0.2. Okay, and this is going to account for any sort of variance in the stock market. So like the tariff news, after the tariff, I believe the S&P fell. It was like between 18 and 22%, depending on whatever it is you're following. Again, if you follow the beta video, you'll understand that things move all around. Depends on what you have. Okay, it could be 100%, depending on what you have. I have no idea. But it's about 20%. So we're going to take your monthly expenses multiplied by 0.2, which is 20%. So say your monthly expenses are, $6,000, which is $7,200 a year. 0.2. So 0.2 is 1,200. That's 20% of 6,000. So 7,200 a month. Okay, is approximately what we're looking for. Great. Now, but we did 100,000 in profits. Okay. We also have to put aside some for taxes. So let's add on another 20%. We're going to tax at a slightly more favorable rate at this. So we'll add another 7,200 would be what, 14. We'll add on another $1,500 for taxes. So that puts us at $8,700 monthly. And you can withdraw your taxes at the end. Doesn't really matter. 8,700 times 12. We're looking at about almost 100,000 a year, but we're making 100,000 a month. So 8,700 a month doesn't really seem like that big of a deal. The rest all becomes return of capital. Like we're just putting the rest in there. Is that enough? Maybe. We still need to be able to reinvest, right, and for the future. Realistically, because if we're doing 100,000 a month and we need really 87, that's 8.7% we have to withdraw. It's kind of a hard, it's a lot. There's a pretty significant amount. A lot of people will stick to the 4% rule, which means you never run out of money. But even if we went to, say, 5, let's just use the 4% rule. A quick recap from the other videos. So the 4% rule means that you can have a safe withdrawal rate of 4% and never run out of money. It's like 99% positive that you'll never run out of money by withdrawing 4%. That's why it's the 4% rule. And what that is it's your annual expenses multiplied by 25 divided by 4%. Gives you your withdrawal rate. Okay. But in this case, we're going to kind of reverse engineer it forward because we're doing options. If we're factoring in the 4% rule, in order to get 8,700 a month, we would need to do about 220,000. Sorry, that's a percent. 220,000 in profits, either from dividends or from premiums monthly, and that would give you $8,800. So you'd be in the variance of the 8,700. That would most definitely give you escape velocity. At that point, you pretty much, your account's just going to grow infinitely, and you never have to worry about it. Can you take out more? Sure. But that's when you start getting into like NAV erosion. So if you have your 500K and you're generating 100K a month, most of that money has to go back into the 500, because so say you're doing a covered call, okay, and it gets called away. You have to buy in at a higher price. That's technically NAV erosion because you can only buy so many contracts. So say it's, I don't know, 50 and it goes up to, 55. And then now instead of spending 5,000 on one contract, you now have to buy back in for 5,500 for one contract. Technically that's NAV erosion. And God forbid the stock price falls, you're locked back in at 55. Maybe it goes down to 51. That's 41. Maybe it goes down to 51. You're subject to that loss. Okay, that kind of sucks. And if you do the cash secured put, okay, the same thing could happen just in the opposite way. Maybe you're constantly buying in at a lower price. You still have to buy back in. You still have to have buy-in. Still, it's very capital intensive to do this. So you're going to end up reinvesting most of this money regardless. This will tick up. This number will start growing exponentially fast. But you're just kind of recycling the money over and over again, which is why I use the black hole as a reference point. So whether it's figure out what percent you need, whether it's 4%, 5%, 6%,